Hello, Warriors. How's everyone doing? Hi, Shahab. We're not going to give you a microphone, Prem. Hello, Surinder, Prakash. Vamshi, how are you? Mark Williams, Kevin Guest, Kevin Hercom, and Brock. Rajesh War. Have a great guest today, Rohit from at India Charts. Great technician, wave guy, I believe, cycle guy. Should be great. So, a few things I want to cover before I hand it over to Blake. Can we agree on one thing right now? That a weaker dollar is risk on. So we're going to see how long S&Ps can fight it, because right now this is live and it also is recorded for later, because the team really shares a lot of excellent ideas and some good teachings go along with it. So we had this low last week in the dollar, which resulted in a reversal week. You know, we came in this week, it didn't look like there was anything special going on. This was your reversal week. By Friday, for a 2-week reversal, all we need is 96, 95. So we're already above that. Of course, everything could change. And as you can see from this moving average and this flat bottom, should the dollar rally continue, that's going to be a real critical, important level to prove itself, to get back above this rectangle breakdown, which comes in between 98.20, 98.50. Depends how thick your line is. So when we came back to this week's action, really very normal, and let pull back to where it had to, hold, dug in its heels, and now we have, a little bit of resistance. Maybe you could call this a right shoulder developing with a breakout here at this 200-day on the 2-hour, and that's going to measure about to 98.50 if we come out of here. So it's going to take you back to the major breakdown. Should we get something like this from here? Everyone see that? Okay, so we're going to see if the S&Ps can thrive in that environment. Actually, I think the high comes in next week, between Friday, Monday, and Tuesday. I have some reasons. There's a count of a certain amount of days that will have equality compared to the last correction in days. June 22nd, I read some of Jim Walsh's stuff. That's where I got it. Not everything I talk about is original thinking. You guys know I'm a big believer in intelligence gathering. And I know that I mentioned a lot of people, look, I'm bringing in Rohit. That's part of it. Our mission every day is to edify you and prepare you for battle in the arena. So we bring in other people that have services, and most people will not do that because they'd be afraid of losing a subscriber. We say, if someone finds something that fits them better, perhaps they needed to have a different experience. So I do a lot of my intelligence gathering right here. Okay. So, instead of, because some of my favorite traders are right here on the team. So, I know a lot of people use Twitter for intelligence gathering. They follow certain people they like. But, you're not going to get this type of work on Twitter. Of course, Twitter is free, just like Face. But, try and top a team like this. I think you're going to have a hard time doing that. And we have Live Squawk here now. We have a relationship with them now. So this too, all the services, you get the chat room. So a lot of intelligence gathering happening in chat after face closes, so that you know, especially if you're new, or you know, maybe a year or so into this, you need to immerse yourself into this and spend as much time as possible. Don't buy the hype that, you know, you could just, you know, turn on your laptop and have your, you know, trading platform open and, you know, just make a few extra bucks every day. Hey, I think I'll turn on my laptop and try and make some money for about an hour before I go out for dinner and party the rest of the night. That's not going to happen. Okay. So you need to immerse yourself in it, spend a lot of time, and our community offers that. And I really like the push alerts that we get too. So, you know, you're still thinking about it when you're out doing your thing out there, maybe putting your mask on and shopping, and something's happening in Euro, you know you're going to know about it. Okay, you're going to get something, the app will push it right to your phone where, you know, you could decide to take action. Yeah, I never believe in taking anyone's recommendation blindly. I like that we have pips because it points your eyes towards something, right? And but you have to look at it, and instead of just going blindly, and see how it lines up with your work, because the key thing is to learn from it. You know, if you don't want to learn, you know, you just find a money manager or a signal service and set it up on automatic pilot and just let things go on auto. If you're a control freak like me, you're going to want to become a discretionary trader. You have a hard time letting go and letting others control your destiny in the market. So that's me. And if you want to be discretionary, you have to put in the time. And this is a perfect environment to do it. There are, you know, many different membership options for you guys. And you could even check it out with, you know, just a $1 trial. My prescription is there. So all you have to do is pick your plan, and pretty simple. Continue. And there you go. Data flash coming up. So really, besides this, all I need is my trading platform. So let's see. Greg is still. Oh, he went with some long silvers here. Looking for 1890. Isn't that nice to have? Because, you know, look at that's much further than I think silver could go. I was kind of thinking 1850, and gosh, that's way up there. And you know what? I'm glad I brought it up. This first time in a while, you've seen silver outperforming gold. Look, gold down 7, silver down here. But in the silver, Greg was looking for 19 bucks. I was figuring, you know, 1850-ish, but look, he's targeting this recent high up here. All right, so if you want to know why he is and what the count is, subscribe. And even the one-day trial will get you going, and you'll be hooked, and you'll sign up. So let's see, what do we have going here? Guys, I joined, but markets remain difficult. Yes. Okay. Okay. Yeah, Chris, I think it's there's also some very good education on the site. Maybe if Joe's here, he could get a hold of you. We do. Okay. Okay. We're considering that. Oh, okay. There Joe is here. All right. So FX Trader, I have no idea why I'm still reading your comments every day. I have absolutely no idea why you are still here. So that's all I could say is the team you know, I guess they can just, read it, not care. But
I
I
like
don't
the
know.
guy. I don't know
Do
about
you?
you. I like the
Yeah.
guy.
Oh, I
Yeah,
know why. I know why you like him.
he reminds me of myself when I was 16.
Real? Oh, okay. I thought he was your contrarian indicator. Okay. I mean, I really don't know why I'm still reading. I scroll up and down the chat. You know, and there's constructive stuff going on from a lot of our audience, and he never has anything to add. He's just like like an FX critic. They critics in movies, movie critics, if you've noticed, most of them have never been in a movie. They're just critics. You know what I mean? So anyway, Blake, rescue me.
Well, listen, I do
Huh?
my own thing. I do my
Yeah,
own thing, and we trade the markets, and it is what
yeah,
it is. So
yeah.
whatever. Doesn't matter to me.
I know.
I just
Uh,
ignore people.
Yeah, and you
Yeah.
know what? You're one of the best at it that I've ever met.
Well, I trade,
You have
and
very thick
that's
skin.
that's
Yeah.
what I do. So
Okay.
I could care less what anybody else says or thinks or
I just
anything.
have too much estrogen in me, buddy.
Yeah, maybe.
Yeah.
Yesterday. So I got asked this question yesterday, like, how did I do with the peso, in our chat room, and because I picked up the dollar mex down near 22. I actually tweeted about it. Every once in a while I'll tweet something and throw it out there for you. It was obviously a little bit of um, uh, stealthy, I guess, because I said it was Taco Tuesday, which, if you guys have been following me on Twitter for at least 6, 7, 8 years, you know that I always I'll call the Mexican peso the taco, this way, because I know there's algorithms that like to read people. Well, at least they used to. People like myself that had a lot of followers, they would just kind of read into our tweets. So I had to start like using like some code words, and so anyway, I picked up the peso, went long yesterday, and rallied, and it came up to resistance. I actually thought last night it was going to break out. This was happening in Asian trade. We were up in the 2240, although I wasn't trading it up there. But I picked up the dollar mex yesterday and got asked, how'd I do with it? And I'm like, yeah, I made some money, but at the same time, I lost some money in the Aussie, so I was kind of flattish yesterday. And if you look at the currency market right now, we are consolidating. And actually we're consolidating in a lot of different markets. So if you look at like the euro dollar, this looks like a head and shoulder pattern. If you were listening to the daily roundup webinar, this is I was talking about this head and shoulder pattern, but I'm not expecting it to play all the way out. Okay, I'm really not. I'm looking for it to play out towards 111.50, but I am looking to be a buyer down here if it gets down there. And what that might actually entail is the euro dollar looking more like a pennant, and instead of a head and shoulder pattern, it might be looking like this. So what I am still looking for in the euro dollar going into the end of this week is I'm hoping that we make a move to 111.50, and then we could be on the long side. Now, if you look at like the Aussie dollar, the Aussie dollar is consolidating, right?
Yeah.
Kiwi dollar is consolidating. I mean, this is you have to kind of wait for the market to set up here. I know it's tempting when you're sitting here looking at the market going, well, I want to do something. I mean, a lot of times there's nothing to do. And I think this is one of those days where we have to let the market break one direction or the other to give us some inclination of what we should be doing versus, the what a lot of people like to do is they like to make the assumption that they know which way the market's going to go. But when I look at what's happening in the Aussie and the Kiwi, that's telling me that we can break in either direction. It's very, we're very much in no man's land right at this moment in time, right? So why put yourself out there until you get some sort of confirmation that there's a move? One of the things that I talked about yesterday, and I'll mention it again, is regarding the upcoming elections, and a gentleman from my office just said, hey, Biden's got a huge lead. When's that going to factor into the markets? I'm a little worried about Biden's lead in the elections. And Dale, were you with me when I was talking about this yesterday?
Yeah. That people would get complacent and not feel like they have to go.
Yeah, I don't know if they're going to fall for that trick twice. Like the Democrats. Yeah. The reason why is because they clearly saw what happened. By not going to the polls or not voting this fall. So I think there's going to be a big push to vote, but that doesn't mean that that's necessarily gonna happen. You know what I mean? But we were talking in the chat room a little bit earlier about the S&P and the S&P, lack of correction. I mean, we're sitting here at 3,100, 3,150 in the equity markets and holding up pretty well. And the only way this market's going to correct, in my opinion, and this is something I was just talking about in the chat room, is if there's a Biden win in the fall, that is going to, weigh on the markets, in my opinion. How far will the stock market correct? I think it will. I think it would probably correct, probably towards the 26 to 2,800 range. Would that be a buying opportunity? In my opinion, probably. The thing is, and this is the one thing that I did mention in the chat room, is that on a Democratic win into this fall, the Fed Chairman Powell will probably not feel the pressure as he has felt, in the last, several years. And I know the argument would be, well, the Fed's supposed to be independent. They're supposed to be independent, but you can't tell me that they don't feel the pressure of President Trump. I mean, he bashes them social media. He's, constantly trying to influence. I mean, absent that, the Fed might not be as aggressively easy as they have been the last few years. So even under stressful conditions. So I don't know. But I think it's still up in the air. Like I said, with the Biden having such a big lead, will Democrats be complacent? And I think it's entirely possible.
I heard Paul's pulling for Biden so he doesn't have to go to negative rates.
Well, yeah, right. I mean, seriously.
Right, man. I mean, if he's reelected, we'll be hearing about negative rates, right?
Yeah, and anyway.
Because if he doesn't get reelected, we won't be hearing about negative rates.
Yeah.
Well, the question is, when does Powell, start talking about negative rates? And I do think if the stock market corrects too much, we will get that chatter. You know what I mean?
Yeah. What else can they do?
I mean, yeah. I mean, right now it's not even talking point, but yeah. I'm sure that it will enter into the fray if the S&Ps start correcting from current levels. You can see this downside correction that we had a couple of days ago, which was what, 5%? Yeah. Or no, I guess it was 9% off the highs. Yeah, I mean that's 8-9% off the highs. I mean, that was gobbled up quickly, and
and that huge day in VIX. I mean, VIX almost doubled, Blake. From 23 to 44. Big move in VIX in a day.
Yeah, and I wonder if the VIX is going to just moderate here above 30 or near 30. And, having volatility at these levels is good for us as traders. Is, we want to see this higher volatility. It gives us more opportunities as traders.
Oh, yesterday was wild, Blake, wasn't it? In the S&P?
There were some vicious moves yesterday, which
show that 1 minute chart.
I mean, yeah, like the Aussie dollar moves were pretty violent yesterday.
Yeah.
And I mean, that's why I made a little bit of money in one place, and then I'd lose a little bit of money in another place. And they were very violent moves. I mean, when you're taking like the Aussie dollar that went from 68 cents to almost 70 cents, I mean, that's a 200 pip move, just, out of nowhere. But like I said, we're consolidating now. And I think what you got to wait for in this market is for some of these triangles to break. We do have Powell, his second day of the Humphrey Hawkins testimony today. I don't think he's going to say anything different. I mean, what else is he going to say? Rates are going to stay low till 2022 and beyond. So, we already know that he's going to be easy. I don't think he's going to be saying anything that will, cue up the market, but you never know. I mean, because like I said, we are consolidating here. Like I said, whether it's the euro or whether it's the Aussie, or whether it's the Kiwi, or maybe even the Canadian. I mean, we're just consolidating, and I think you get, the prudent thing right now is just to wait for some breaks and try not to get too aggressive at this stage in the game, as much as it's tempting to just start, getting long or getting short something because you think the dollar Canadian is going to break out, or, you have this feeling that the Aussie is going to break higher or it's going to break lower. Let the market tell you what it's going to do versus you making that assumption. Because I think right now the chances of you making money is probably 50-50. And when the chances of you making money is 50-50, it's probably best that you just, wait for the market to show you its colors versus you assuming which way it's going to go. But that's my thoughts on the market. And right now, you look around like the NASDAQ. This was, to me, this is one of those things that I'm still scratching my head. Last week, I mean, we closed at a false breakout in the NASDAQ, and here we are back up at highs. I mean, I'm not trading the NASDAQ. I'm just looking at it going, wow, how it's hard to be short risk when you have the NASDAQ that is as buoyant as it is. Do I think the NASDAQ deserves to be up here? Probably not, but it's up here, right? And because it's up here, you have to respect the fact that it's not selling off. It's not, there's zero interest to sell. I was just reading a statistic. This is interesting. Let me read it to you. Give me 1 second. Where did the stat go? I was just reading it. Here we go. There is nearly 5 trillion in money markets currently. This is nearly double what it was 5 years ago. Also, the recent 3-month change was the largest spike ever. So what that tells you is there's a lot of money on the sidelines right now. And that's via Ryan Dietrich. And that suggests to me, and if you think about 3 months, right? Over the last 3 months, which go, we're in June, so go into, March to June. All right. 3 months being, pretty much this, right? From here to here, roughly. Okay. Actually from here to here. Okay. Roughly 3 months, the market has gone, in massive money markets, and it has not redeployed that money. And look where the markets are at right now. Now, that doesn't mean that that all that money is going to get redeployed back into the markets, but there's a lot of money on the sidelines right now. You know, will that money be tempted back into the markets? It could, especially if we start hitting new highs. You know, I thought that, and I'm still, I think it's still up in the air that we just break new highs and get everybody chasing the market before we actually fall. So fall into the fall, like equities come down ahead of the elections, what I mean. And this is not your normal summer. And this is the one thing that I did bring up during the week ahead video, is that this isn't your normal summer price action where you get sell in May, go away. And why is that, Steve? Stelios?
Why is that, Blake?
Why do we not get sell in May and go away this summer?
Because we got COVID instead, right?
Yeah. Who's
so
vacationing?
go away where? Yeah.
Go. Yeah,
where?
right. You know, most. I mean, everybody's at home. No one's traveling. Well, I mean, you know, it's very limited. So
Yeah, don't look at Stelios. He's traveling every week.
Except for Stelios, that
Yeah.
Hey, I was on a sailboat with a few friends. No COVID there.
But when
I assume we're going to find that out tomorrow, Stelio.
Yeah, true.
So anyway, I would just, I don't know if you guys heard most of the conversation that the things I've been talking about it, but it's just like we're consolidating right now, and there's nothing suggesting that we should be, aggressively being long or short at this very moment in time, right?
Yeah, agreed. We're kind of, I think we're kind of grinding slowly higher in equities before the next move, whichever way that is. I think it's going to be lower, but could well be higher. But
I'll tell you, Stelios, you were you even called it like the last couple weeks. Wait till the market gets back above 3,100, and it's probably a sell up here, and it may be. But the downside has been fairly limited, right? It has been.
Yeah,
so.
every dip is being bought. That's for sure.
Right, every dip is being bought by all
even scary ones like the 5% last Thursday. I mean, that was scary, and within 2 trading days, we're back on top. So that's crazy.
Yeah, but Steve called it perfectly. He covered his short down there, and that was a great call, Steve. And that was the second blip. I mean, it was like down right around here. Really, really good call on the NASDAQ. I think it was NASDAQ, wasn't it? Or was it the S&P? I can't remember.
No, the S&P.
Oh, it was the S&P. Yeah, down here. Yeah, really, really good call. Obviously, in retrospect, it was very divergent intraday, but great call. So today we have Powell's second day of testimony. Are you guys expecting any fireworks, or is it just me that's not expecting any fireworks?
Perhaps some Comedy Central, like the Fed is not monetizing the debt, and there are some gems coming out of his mouth. I really enjoy them.
Well, hopefully I've left you enough, because I barely talked about any of these majors other than the consolidation that we're seeing in some of the major currencies here. I left you enough to talk about going into the next half an hour, and maybe we will get some fireworks today. I mean, we only consolidate for so long, right? And based on what I'm seeing here, especially if you're dealing with the hourly charts, the consolidations look like they will break today. And maybe the catalyst is Powell. Maybe it is.
Yeah, it is likely. We've been coiling for quite some time. So yeah, I agree with you, Blake. I mean, you know how it is. This market is also being triggered very frequently by algos. So if Powell says one word more or one word less, that can trigger an initial move out of it, and then we might have some follow through that's going to be purely technical in nature.
Yeah, well, maybe things heat up between China and India, and instead of throwing rocks at each other, they start doing they have a big twister match on the border.
Well,
I
Blake,
bet you that the market is going to buy that as a good thing until nukes actually start falling. I mean, this market
they're only doing death twister.
Yeah.
It's an interesting coincidence that President Trump was there at the start of the pandemic here in the U.S. with Modi, and by then he had already decided how this whole thing got started. And you're right, perhaps we have a proxy with against China now. So call it a coincidence. Maybe they, worked out a deal.
Yeah, maybe.
That's some numbers,
We got housing starts which were worse, but nothing to write home about.
Canadian was bad.
What was significantly better, but of course market participants will say worse, was Canadian CPI, which was a lot weaker than expected. For real economic terms, that's excellent. Of course, central bankers will be like, oh my God, cost of living is going to be going down. We really need to do something about it.
Let's add more liquidity.
Yeah.
So, economic data is not going to matter much, although we do have Australia employment tonight, which could move the needle a little bit. I think Australia is looking to lose 100,000 jobs, maybe. That could be it. That could move the needle a little bit later if you're following the Aussie. But other than that, all right, guys. Well, I'm going to pass it over to you. Good luck to everybody today. For those of you that are not or that are part of the ForexAnalytix family, I'll see you on the daily roundup webinar 4 hours from now. And for the rest of you guys, thank you for listening in and always supporting us. And remember, visit Forest Park FX. They are our partner and helps deliver this this webinar every day. And
you could have a picnic
visit
there too.
Visit Forest Park FX so you can actually help yourself and make
help
back
yourself
some of the money you're paying to your broker.
Right. Okay, guys. Have a great one. Thanks, everybody.
Good luck.
Thank you, Blake.
Thank you, Blake. Hello, guys.
Hey,
How you doing?
Stel.
Hey,
guys, I've been thinking about this Robinhood. I think it's a misnomer for a brokerage firm because I know, the fable of Robin Hood, he took from the rich and gave to the poor. But as long as I've been in the markets, the Robin Hood in the markets takes from the poor and gives to the rich. So I think it's kind of a misnomer.
that's how it usually works, isn't it?
Don't you think?
Yep.
I'm with you.
Isn't that normally what happens? I remember when I was becoming a member at the CME and I had to go before the membership committee and they're interviewing me and I couldn't help but feel like, here's some more money we could pick this kid's pocket, like a piece of meat. Yeah, come on down and trade with us. So anyway.
I think you're right, and I've traded on both sides, and having trading now for my own account, and that was you guys know I was a market maker before for a decade. I tell you what, the information you have when you're working at a big bank and the support is incredible, and obviously the deep pockets as well help. But it's a completely different.
It's playing
game.
a totally different game. I mean, you have a complete view of what's happening, in the market. I mean, where the bids are, where the offers are, what kind of real interest there is, to buy, sell. You are in direct contact with, the big money. So of course, this gives you an amazing advantage.
Yeah.
You mean candlestick formation isn't as good?
I can actually tell you that.
I knew you were going to say this. Yes, it is as good.
That actually it might even be better because sometimes, and we've seen that very frequently, since everything is incorporated in price, even stupidity. I mean, even whenever the market participants have gone really, nuts, everything is depicted in the price action. While other stuff have the tendency to more or less trigger our psychology and our emotions, which rarely are a good advocate of making the right moves in the market, right?
Yeah.
Yep.
Stel, what else did we have today besides the data that we just got?
We had a couple of bits of data. Excuse me. Main one being UK CPI came in line at 0.5%. So that's getting close to zero, as is most major economies like Eurozone. We had CPI as well, 0.1%. So we're getting close to zero. Accommodation is still warranted for the central banks. I mean, they will look at anything they like to put more accommodation, but they have the number there to support it. And really, we're waiting for Powell later today, although I doubt there will be anything new coming out. And tomorrow, let's not forget, it's Bank of England interest rate decision. We could well have something there, although no change is expected, of course. But the Bank of England, they have been, the MPC has been. They've said they're not considering negative rates, but it's not out of the question. So, negative rates might come into the statement or Q&A. That would be interesting if it does, although I don't think it will. But, this is the one thing that I'm waiting for tomorrow.
Yeah, the cable has been, the pound in general has been rather stable. Stock indices have recovered. So I doubt it that they're going to bring it in the forefront, at the moment. But I do think that, the next downturn, it's the first thing they're going to, use to throw at the market, since they've already obviously considered it.
Yeah, and let's not forget that things are hotting up a little bit in the UK-EU negotiations. There's been a few things said from each side. Boris Johnson has been saying we have to sort out something now and not by year end. So I think we might start to get a few more tape bombs like we did in the last year or two. So the pound is probably going to be a little bit volatile. I have a bias for a stronger pound. Because I think a lot of bad things are priced in, and I still think there will be some kind of agreement in the end, good or bad, I don't care. But I think something is going to be ironed out and announced.
And I think we might even get a better buying opportunity if the agreement initially is considered to be bad, which it's a likely scenario.
Yes.
I think that any initial sell-off due to whatever terms of the agreement the market dislikes, I think it's going to be a great opportunity, because soon after the market is going to focus on the more important thing, which is that this thing is over, the uncertainty is off the table. So, good or bad deal or whatever, the UK can start, the new journey out of the EU, and it's not going to have that burden weighing it down.
Yeah, uncertainty is the enemy, basically, and when that goes, I think it's going to be, it's probably going to be good for the pound. What else is there to say? Really, I mean, in terms of markets, I will repeat everything I said yesterday. We have a lot of things brewing. China have been closing down schools and flights and airports now, and they're, I always look at what they do and not what they say. So the first wave, their reaction was phenomenal, right? They were closing down areas of 50, 60, 70 million people.
Which more or less made it clear that things were not as simple as they initially were announcing.
Yes, exactly. And obviously, I don't think they're telling us the true extent of the damage that they had. But, even seeing them taking these measures, I mean, it tells me that this is not a
over
thing. It's not over, and it's pretty serious. And I hope it isn't. But I'm just saying, look, this is what I'm seeing. So the market is merrily going a little bit higher, squeezing higher every day, taking out shorts while things are brewing below. And yes, granted, we have the Fed and most central banks in the world buying everything, and eventually they will win. I think the equity markets will go up in the end, because when you have these huge buyers and when you have inflation, there's no other way. So any big dip, I think, should be bought, but the market seems to think that any dip should be bought, even a 0.5% dip or 1% dip. So I do think that as soon as, like Blake said, the cash on the sidelines, as soon as we have some of that going into the market, maybe with a new high, perhaps, then the market it's going to be easier for the market to drop.
Plus, central banks have one more big bazooka that they can throw at it the next time, we have a huge sell-off, and I'm pretty sure that they're going to use it, which is changing, in the case of the Fed, changing their mandate and changing, the Congress's, whatever it's called, like, I don't remember how it's called, the thing that gives them, like, a list of what they can and can't do. So once they remove the obstacle of not being able to buy equities, which I'm sure it's going to happen next time, we're in big trouble, they will do that as well. There is only one backstop, which I think that we're going to eventually hit because it's unavoidable, which is the currency strength. So, all this madness is going to stop when money printing is extremely more destructive than, letting things just, blow up.
Yeah, find their own balance. Yeah.
Yeah, exactly.
Even if that means, certain markets going bazookas,
which they will, and for every time they try to postpone this pain, they do manage to bring it forward in the future, but they guarantee that when the day of reckoning comes, the blow up is going to be, unbelievable. I mean, I think that it's going to go in the history books.
Well, I hope it doesn't, but yeah, I kind of agree.
Yeah.
Federal
Reserve Act. Yes, thank you very much, Itai.
Our friend Kirk says boomers won't chase a high. Talking to dozens of clients, they want to buy the 2600, 2800 dip if there's not a catastrophe. That makes sense because I think 2700 was the level I was looking at, and in the S&Ps this is, and I agree with that. The question is when we get there, because I do think we're going to get there. What happens then? If there is a major event that causes this, we might go lower again. And imagine if everybody who's waiting to go long goes long there, and then there's nobody left to buy. That's usually when the market just goes one way and, without looking back. So let's see. Let's see what happens. It's still a long way.
Only certain thing is that doesn't mean that stocks can't just keep pushing higher because, all this madness. But once again, given the backdrop at the moment, and all the pending issues and all the unresolved issues, the risk reward is clearly tilted to the downside. Now, that means a lot less than it would mean some years ago, unquestionably. But don't fool yourselves. If you want to be buying here, you do that kind of blindly. And you just cross your fingers and hope, because there are a lot of things at the moment that just them turning a little bit bad for a few days can cause a 10% sell-off in 3 days easily.
Yeah. Well, one of our friends here is saying 2700 is never going to happen. You are so far away. I will buy at 0%. Okay, so you're selling me at 0% this trade. Thank you. And when people say something is never going to happen, that's when it's going to happen. And this is a classic rookie mistake that I've made in the past as well. But anyway, I guess it's a market, and this is what makes a market fun. All right.
Yeah, you have too much estrogen too, Sappy.
I do,
Stephen Blake don't care, but you and I we care what people say. It's a curse, buddy.
and let me clarify, I'm not short equities. I shorted 30.50 and 31.15.
But really, FX trader, if you want us to make an over the counter market and you want to sell us a put, for 2700.
Look, he keeps making comments. He's not following what we're doing. Anyway, so just forget it. All right.
I'm going to buy that put, and actually, something. I'm going to be, I'm going to be really large. You're offering it for 0 cent on the dollar. I'm willing to buy it for 5 cents on the dollar.
Okay, let's move on. That's it for me. I don't have anything else, so we can go to the charts.
Okay, so S&P backtesting this broken wedge. Let's see if it works here. If we have a fast look at it on the 4-hour chart, here we are. Clearly consolidating during the past day. Let's see which direction we get resolved. I still favor one more leg lower before higher. So, more or less that is what I still favor, having to do with direction. But as I've said, this is not an easy market to short, and you should keep your targets rather conservative. Now,
does anyone want to know the day of the top? of this correction?
Say
Would it
again?
be handy? Would it be handy to know what day this rally terminates?
You have it?
Yeah, I have
Okay.
it, man. All
Be
right.
my guest. Share it, please.
Okay. I'll tell you. I'll Skype it to you later. It's a secret.
It's a
It's-
secret. Okay.
We're pretty close, man.
Okay.
I'll tell you later. Okay.
Okay. Looking
Keep
forward
it under
to it,
your
Dale.
keep it under your hat. All right.
Looking forward to it.
All right.
Okay.
If anyone wants to sign up, I'll tell them on Skype today. But that's it. And I'm telling you, it's close.
Just one thing, since we had Canadian data before, Canadian data didn't really move the USD CAD at all. This is a 4-hour chart, by the way. So, whatever looks like a little movement, it's not actually a movement at all if you look at the daily. But I do like the initial reaction we had higher. So I do think that at the very least, we should expect one more leg to the upside, at the very least, to at least retest this channel. I mean, you can see it's quite a nicely defined channel. So 138 is where we find resistance in the moment. That means another 250 pips of upside is likely. What would help this move higher? Two things would help this move higher, which both of them are likely if they happen together. Risk turning lower, which we know that risk turning lower usually also means crude oil turning lower. Now, having to do with crude, actually, let's first have a look at it on the daily. There it is. So, crude, still holding this steep ascending channel. Momentum has, clearly started waning. We are now seeing divergences on all time frames from the daily and below. That's, another thing to note. Not unlikely to see another push to the upside, but I think it's going to be very, very tough for crude to penetrate through 40 before we have a deeper correction. So from a risk reward perspective, I think that, the upside is now quite limited before we at least see, a decent pullback. As I've said many, many times, having to do with the continuous price, I think $29 is going to be a nice support area. Not that I would rule out, even a deeper correction than that. But, $29 I think is more or less an easy target for crude to pull back to before we can see more buying interest. And for full disclosure, I actually sold my total stocks today. I made a decent profit on those, and I'm considering buying once we see a deep lower in crude. So if my assumption is right, and we do have another leg lower in risk and in crude, I think we're going to get a better opportunity to load up on assets that are correlated with crude later on. Now, is it going to be the case or not? That's what I think. So that's how I act.
Steve.
Hey, Gregor.
Hey, how are you?
Good, mate. Nice to have you here.
Yeah, nice to be here.
Okay, I'm here every day, so why don't you grab the screen and show us what you have for us? Starting from, I guess, stocks. And the reason I'm saying starting from stocks is because a lot of things have now become one trade, risk on, risk off. Even the vast majority of FX currencies are trading.
Yes, they are acting like this, yes.
Yeah.
So actually, on the S&P 500 week, I covered this one already a few weeks back when highlighting this S&P 500 and put call ratio. So still at the bottom, I have put call ratio. Actually, it's inverted chart. So it means if this ratio is moving into extreme, market is buying a lot of calls, means the investors expect higher prices in the future. But since we are moving into these extreme levels, still, I think that there can be limited upside. But keep in mind that S&P 500 still has a February gap unfilled, which is above the recent swing high. So there is still a chance that we will see maybe another swing high and then a pullback. But I think that when summer is now approaching, I think that market could stabilize a little bit, slow down. The only question is if we will see maybe a deep corrective retracement or just a sideways price action. But the important is that we have seen this movement from March lows to current levels in very short period of time and very quite fast and impulsive structure. So it's definitely, we definitely sooner or later will come into the period of consolidation, and based on months that are approaching, I think it's a perfect time to see a corrective movement. And also, as I said, the put-call ratio is moving into extreme levels. So even from that perspective, I would assume that we may see corrections. But corrections are not always simple, like a clear ABC pattern. They can be irregular. So it's very hard to trade this market. And definitely, I'm not looking for any kind of a short on stocks. I would rather look, maybe if you expect stocks to come down, why not rather look maybe on opportunities, maybe on metals, or maybe even on 10-year US notes, or maybe TLT. So from that perspective, I'm also looking at the 10-year US notes here, bullish picture. We have a triangle here in the middle of a very big uptrend. And if you look at those cycles, you can clearly see that they are very similar. So here there was a pullback down on the 10-year US notes from mid of April till start of June, at the same time when stock market has been on the way up. And then stock market actually broke this trend line that you also mentioned. And it looks like that this is the first evidence that we are maybe stepping into a sideways or into a consolidation period. It will be, as I said, a very deep correction, or you should also aware that corrections sometimes can be just moving to the right. They can be in a very tight range as well. Okay, so what I'm looking at and expecting is that this is a triangle, and we are now in a wave E, since we have seen limited upside here at this upper line. Ideally, we will see a break to the upside. So if we see this trend line broken, we should be aware of, it would be just another reason actually why the S&P 500 is going to see limited upside. But keep in mind that the S&P 500 is not that far away at the moment when looking at the futures from these June highs. We are quite close actually. So there is a chance that we will actually take these highs out, and maybe they then even stay into this irregular correction that I mentioned. But as I said, fourth wave is here on the 10-year US notes. Sooner or later, I'm expecting this market to accelerate higher into a fifth wave. And once this happens, of course, stocks will have a very hard time probably to break this resistance. So let's take a look on the S&P 500 count. Now the primary count is still, as you mentioned yourself, it could be just a temporary pullback here for a wave B, but as I said, it could be also irregular wave B, okay? So watch out also.
So for a flat,
yes, and if it happens irregular wave B, you may see even this February gap filled. So when looking from that perspective, I really love this kind of development, because if we see a break above these recent highs, I think that there will be even more investors again after this sharp drop turning back to
buying, and then
they will be buying into
holding the bug,
strong resistance area, and that's probably a timing when I should be aware of potential different sides. So technically speaking, still I think that stocks will be offering a very good buying opportunity, but I think that's not the right timing. When looking at, if I look back at this put call ratio, you want to buy when market, when this ratio is actually when puts are at the extremes, right? Not when calls are at the extremes. So I think that there is a new cycle coming in the very near term, and ideally this will unfold, as I said, through the summer. Now, if we're looking at currencies, if we really are headed into some kind of a period of consolidation here on stocks, then watch out, obviously, the US dollar and Japanese yen. So looking at the US dollar index here, again, I've been looking and tracking, as you know yourself, this triangle a few weeks back. I've been looking for a wave C drop, and looks like this wave C now traveled into the very interesting area. If you will compare wave A to wave C, you will see they're equal. But what is really important is that in the middle of this free wave drop, keep in mind that each free wave movement can become 5-wave movement. I don't want to be the one that will say this is the end of the correction, we are going higher. I always want market to confirm what I'm looking at. Okay, so if we'll get a 5 waves up and maybe reversing back towards 99, back into this area of consolidation that was in place through April and May, then I think that we are in stage for a new leg higher on dollar index. But why I think this may happen is actually because in the middle of this drop, we had a triangle. And always when we have a triangle in the middle of a free wave drop, we know it's not wave 2, it's wave B. And if it's wave B, then the whole structure should be corrective, either part of a complex correction or the whole correction structure. So in my opinion, dollar could see more upside. And if we consider that stocks could be moving into the resistance as well, then maybe this makes sense actually.
So you're waiting for this first move higher from the lows to determine if you want to buy the next dip, right?
Yes, to be even more confident, of course, that we are going higher. But looking at the lower time frame charts, set maybe on euro, here we are already seeing the first leg up, wave B. So it looks like that we are in the third leg of decline. Either this is going to be wave C, wave 3, I don't know. We have to wait on more price data to make sure. But at least in the near future, there is a room for another 100 pip drop here. So I'm definitely looking here for more weakness in the near term. Cable also, we have seen a very nice rise here up from May, clearly with 5 waves. And now it looks like that we are making a bearish impulsive reversal. Either that's a wave A, can be wave 1, but looks like that the third leg to the downside can be coming in the very near future.
If that's the case, though, that would indicate dollar strength, and usually dollar strength lately goes with stock weakness, which would indicate that most probably we're going to have another leg lower in stocks, as we were talking about earlier.
Yes, exactly. So, okay, I mentioned also metals. So let's take a look on gold. Now, gold is definitely bullish here on this chart from 2018. Even if I have marked a potential bearish wave count, okay, it's still a bullish trend. Okay, these are two different things. So I'm looking always when I'm trading, I will try to find the opportunity within the trend, okay, within the current price move. So trend is still up. And before I can say that wave C is finished, I need to see a completed subwaves, completed pattern on a shorter term, on smaller time frame charts. So looking at the 4-hour here, actually I'm looking at potential ending diagonal. What is the most important here is that we have the characteristics of a corrective price action since April and definitely since May highs. So it's a consolidation that suggests more upside. The fact is that this move down from 1764 cannot be counted in 5 waves. You have too many overlaps, and in fact, those overlaps were made by 7 swings. So this is a complex correction, either as part of a very big complex wave 4, or maybe as its own wave 4. I have another wave count. But what is the most important thing is that from that previous swing support, okay, we rallied with 5 waves. Okay, so it looks like it's impulse that broke the first trend line. You are now at the second trend line. That's also looks like market wants to break it higher. So I'm expecting more upside based on this wave count into wave C of wave 5. That's one wave count. I have another wave count here, which suggests that actually here we are in a triangle. Now, this is very important because if that's a triangle, then wave E could actually move all the way back to the lower side of the range. So in such case, invalidation level would actually be the extreme
lower, yeah.
wave Actually, could be a wave C, but because triangles can always become more and more complex, wave A is the extreme.
Yeah, but in both cases, the outcome should be a higher high.
Yes, exactly. I just want to say that in a wave E, don't get scared if you see 1680, 1685. Now, and another wave count that I have it here is this one. It's actually very nice, clear bullish impulse. You have wave 1, wave 2, another wave 1, 2, 3, 4, wave 5 for this extended wave 3, and then you have this wave 4, as I said, 7 swing correction, back into the area of supports here of the previous fourth wave. And we have seen again a very nice bounce. So it looks like that even this wave count is pointing to the upside. So I think that gold is looking very good here for a push to a new high. And to add this, even silver has a very nice wave structure as well. So looking at silver here, we have definitely a very nice uptrend here. Looks like that making an impulsive recovery. In fact, recent pullback from the highs was clearly made, as you can see here yourself, by 3 waves, okay? A, B, and C. And notice that wave C found the support at this equality level. We rallied from there quite strongly. We broke this trend line and looks like
and now we're consolidating.
Is to the upside. Yes, I really like how the price action actually is acting right now. You can see the sideways price move, while the previous rise was a very strong one. So that looks like an impulse. This looks like a correction, and I think that more upside can be coming towards 1780. We will see if this would be fits to be a wave 3 or wave C as part of just another even more complex correction. But I think that in the near future we could see more upside here.
Nice.
Grega, you want to throw us a very, very quick outlook on crude because we have the interview?
Yes, now crude oil is a little bit tricky here on the intraday chart, but I would rather focus, whenever you have a very tricky price action on the lower time frame charts, don't bother with the sub waves, with the structure, make a step back and switch to the higher time frames and look for clarity there. And here I can see very nice clean 5 waves up, and looks like that we could be in a corrective phase. But again, this is a corrective phase. Corrections are not always very simple, very clear. That's why I have to be very careful here. I think that there is no good opportunity to short it, but I think there will be a good opportunity to buy it
later.
We see a pullback. The only question is if we see wave C from here, or this wave B goes even more complex, becomes even irregular correction, who knows. But the key is that correction is incomplete. But why I'm saying that is not clear if we'll see a drop from here is because I can count 5 waves down here on the intraday chart, but notice that even this rise can be counted in 5
waves.
So it's very hard for me to say this is wave to be, you have a short opportunity against the recent high on this July contract. It's a very tough one. So my job is actually to look at the price action to find the clear pattern and then provide maybe some trade idea. But at this stage, with this kind of a price action, despite this 5-wave fall, I think that's not the case on crude oil at this stage. So better just watching from the distance, and let's see if we get lower prices for better entries.
Thank you, Grega. Thank you very much.
Yeah, very nice, Grega. So ending diagonal in gold, I just have one question. After that peak, is there a chance for intermediate term bearishness after, say, 1780 to 1800?
Yeah, at least a pullback into a correction would be, if not something more aggressively bearish, at least a 3-wave drop is what you would expect.
Thank you, buddy.
Thank you.
Thank you, Steve.
Thank you, Coach.
Grega and Rohit. You have a lot of people waiting here for you, and I understand why they are, because your work is great. So I'm going to promote you to panelist here, and I'm going to get you set up. I've just unmuted you. Welcome back to Face, Rohit. How are you, buddy?
I'm great. Thank you for having me again.
I look forward to seeing your screen and your work, you know, and you have a lot of You have a nice following. People are hanging around to do this. Before we get started on your technical work, I just want to ask you, you trade from India, right?
That's correct.
All right. So what is the media talking about in regards to this minor clash between India and China in the Himalayas? Are they even talking about it in the Indian media? And what's the talk on the ground there? That this is just something that happens all the time. It's not unusual, and kind of like what happens between India and Pakistan and Kashmir.
So that's how I would like to look at it. But of course, every time there is a clash, it creates a lot of sentimental noise all over social media and in the uh, front media itself. So people start worrying about, whether this is something bigger. Is it, whether can it really lead to a bigger clash? But we've seen many of these small ones over time. They come and go. There are some small issues that have to be resolved. I think most of the communication I've heard from yesterday simply says that they don't want this to, get any bigger. So I don't think it will escalate, and it should just, get taken care of.
Well, I know you talk about the seasons of an economy, of the world, and winter, and many other people who talk about this, Kondratyov or other cycles that point towards us being in the winter season. War is part of that cycle. Even guys like Martin Armstrong and people that do that. And, I just thought it was, kind of put it together that during the beginning of the pandemic, President Trump was visiting with your Prime Minister Modi and wondering if they came up with some kind of deal, and India's going to be a proxy for us because the U.S. is already in a Cold War with China.
So it is, what you're saying is right. And from an Elliott wave perspective, and I think Robert Prechter's studies shown that a lot of these events, whether it's pandemics or whether it's in the form of war, all occur in wave C of a bear market, or either at the early stages or late stages of wave C. So sometimes the event itself occurs, if it occurs in late stages, the markets in themselves may bottom out and then start recovering from there, which is why they actually provide us an opportunity, because if the news was not so bad, prices would not be down and you wouldn't have the opportunity to buy low. And I think that's part of where the narrative is. I think right now in my mind, most people are caught up still in thinking about whether the pandemic would spread into a second wave and there'll be future effects and so on, and they're not thinking 1 year down the line. So most of the thinking is probably 3 month and 6 month. But we've seen, at least in the Indian market, a 40% cut in the main index. But it's been a much deeper cut in the mid cap and small cap stocks, or what I should say is the broad market, because while the main indices didn't reflect this, the Indian market actually peaked in 2018 with a lot of Asia. I think most of Asia did not stop making new highs from 2018 onwards, even though India did in terms of its main index. But the underlying indices were not making higher highs, and so they kept on declining and fell much more than 50%. So there are stocks that are down 80%, 90% as well. So we've actually been through a pretty severe bear market with the COVID situation, probably aiding the last phase of that. And so I think what we were probably thinking about in April, that there could be one more wave down. I think that's where I left my last discussion with you. That one more wave down would be on the back of a last deflationary shock which could come if the dollar spiked higher, and which is why I have the dollar chart on my screen, which I also shared last time.
Right. So what you were talking about, the same thing has happened in the U.S. market, even though a lot of our, especially with the mega cap stocks that are carrying NASDAQ to new highs, that, you could look at the Russell, you could look at the transports, you could look at a lot of things that are not making new highs or close to new highs. So why don't we start with this chart that you have up here right now with different animals being representative of the cycles, and it looks like we're halfway through this or maybe halfway through this last cycle that you have up there what is that an elephant up there? I'm not sure.
No, these are bulls and bears.
Oh, it's a bear? Okay. Elephants never forget. All right. So tell us what this means to you and what we should be thinking to, not only look at opportunistic things, but how we go about capital preservation techniques in here.
So what I tried to put out is cycles that were repeating in the dollar index. So this is of course the dollar index from 1967-68.
Yeah.
And what we've seen is repeated bull and bear cycles lasting between 7 and 9 years. So we had a 7-year bull, then a 7-year bear, then 9 years, again 7 years, and again 9 years. And so in 2017, when we hit 104 on the dollar index, I also, of course, Elliott wave wise, I thought we were done with maybe an ABC. And maybe we could start another 7-year bear market in the dollar index. What I probably didn't anticipate is what has happened post 2018 is we've actually retraced almost 90% of that loss. And I was watching it very closely because throughout this COVID situation, the dollar index did spike and there was the potential for that one last spike. Maybe you'd go past 104 and make a higher high. But of course, the Fed stepped in and we've not seen the dollar index really go past the 100, 101 mark. Now, in doing so, what you end up with in the spot dollar is a near double top, or I would say a lower top. So this entire fall, I did think that it is a 5-wave decline, whether I mark it as 1 or I mark it as A. And we've had this prolonged second wave or B wave. And what I've been waiting to confirm is that we have started wave C down, or a third wave in the dollar index, which would, and of course, 7 years from 2017 means by 2024, we could be looking at much lower levels, or maybe a new low in the dollar index below the 70 mark that we made in 2008. So that's the broad thesis. And once we get that confirmation that the dollar index is rolling over, so far it's showing so in maybe the daily, weekly, or monthly momentum indicators. But of course, you wanted to break these multiple swing lows and supports near 95, 94 that it has made for more certainty. And once we get that, then what we are looking at really is a reflation trade. And that's what I started to write about from this month on, is that we may have shifted our regime from deflation to inflation. And the last time around, when I was thinking maybe this is a bounce and markets would fall once more, it was to expect that, okay, if there's one final spike in the dollar, you'll get that sell-off in oil and commodities. And out of all the commodities, probably oil was the only one that fell off for maybe completely different reasons. Rest of commodities did not confirm that new low that oil saw all the way down to $6 at least on the official price, not looking at the futures negative spike. So once you've done that, I think it met all the long-term projections for oil, and you also ended up with something which I will call an intermarket divergence, which means that you ended up with a new low in oil without a new low in base metal prices, also without a new high in the dollar index itself. So this to me, you ended up with multiple long-term intermarket divergences between the currencies and commodities and within the commodities themselves. All of them indicating that probably this was the change point where we are now shifting our regime from deflation to inflation and need to position ourselves very, very differently according to that.
Okay, so this last flush with COVID and crude going negative was the last hurrah for deflation, and the dollar index needs to close back under 94 to kick off a C wave to the downside to confirm it.
Exactly, that's right.
Okay, all right, interesting. All right, so this is a different tune since you and I were on together. So tell us what you're doing to start to position yourself. Obviously, you're looking for dollar shorts. Do you have a relative strength leader? What's your favorite fiats for taking advantage of a big dollar decline should it manifest?
I would think probably the Australian dollar, because that took the lead. It was the first one to start dropping. It's also a major commodity producer. So in effect, I think any currency pair which comes from a commodity producing country is seeing more strength than the others initially, purely on that basis. So that was the simple analogy. I would have
Okay.
expected probably the USD INR, which is our own Indian currency, to strengthen much more, but it actually has not. So USD INR has still not strengthened as much as rest of the emerging market currency pack. Yes, so
What do you say to the people that are, you know, still looking for a blow off in the dollar based upon, you know, their views that there's a dollar shortage because all the debt that's denominated, emerging market debt denominated in US dollars, that a revaluing up in the dollar could be used as a geopolitical weapon with China by making it more difficult for them having to defend the yuan. What do you say to the guys that are talking 110, which I believe you were at one time talking about higher levels in the dollar? Weren't you talking 110, 115? I mean, some pretty high targets.
I was open to those numbers, and after that 2017 change, I for a long time thought the dollar bear market had started, but I did again flip and consider the possibility of, you know, going to 110 and 120 early part of this year. But I think the whole failure of that dollar run to continue, which may have been purely because of the Fed stepping in, has sort of resolved that to some extent. And I think we have to pay attention to what central banks are doing, because I think one of the biggest changes where we make a fundamental argument on currencies, and what I think we sometimes forget, is that we are no more on fixed exchange currencies where, you know, the weakness of a currency is reflected simply in its money printing. We are in floating rate currencies where, you know, it's really an exchange based on, you know, capital flows or current account flows. And there will be separate central banks taking similar actions. And so net, while you may have weakened the currency internally at a domestic level, it may not really show up in the currency rate itself. So that's where we can get, you know, confused between the fundamental argument and what is actually happening in price action.
Okay. What technically would flip you back to a bullish dollar position? Do we need to take out 103?
Yes, I think if we go past the recent high itself, which this is of course the DXY continuous, which is the futures. So 103.9, I think, is the high we've made here, and we would really have to go past that to change this view again.
Okay, great. Thanks for updating us on your view. I mean, there are valid arguments on both sides. I guess that's what makes a market.
Yes.
Okay.
So with that, I'll switch to the Nifty. I think that's what concerns a lot of people in India. And in terms of positioning, so when I look at the dollar and reflation trade, the first thing I of course think of, apart from being, you know, short on currencies, I actually think about being long on the commodity space. So that's where then it takes you to the opportunities in equity space. So suddenly, if you're bullish on not just precious metals as a deflation hedge, but also along with that into oil, energy, then, you know, you have base metals, copper, aluminium. So suddenly, all of a sudden, you're looking at the entire metals stocks. So not just the gold mining stocks, but you're looking at producers and, you know, all commodities that could gain from rising prices. So there you have a completely different trade. So I'd end up looking at even the Indian metals index, which I can come to, but let me first speak about the Nifty. So how I've had to rethink about this is that if we didn't have, including India, not stepping in to really reflate the economies, I thought that in terms of the economic winter, a lot of damage had been done in India, because between 2018 and in fact, I should say 2015 onwards, I had written about India being in an economic winter prior to that, and we started to see the damage being openly admitted after 2015, because we first reported our non-performing assets in the banking sector back then. And once we started to do that, 2-3 years down the line, we ended up with a financial sector crisis in the shadow banking sector, which is the non-banking financial sector in India. So we ended up with a couple of companies going down, and that could have become a bigger crisis. But what you have now is the Indian central bank backstopping the entire thing they've not only stepped into the bond market buying almost 2 lakh crores worth of bonds in this year, and also making a very clear statement, I think, once the COVID crisis was out, that they would not allow any of the banks to fail. So I think that statement, which they repeatedly said in the last week of March, is a big step in changing what could have been the final outcome of the debt crisis in India. It could have led to more defaults, and it could have spiraled in many different ways, but they've sort of stepped in and said, we're not going to let that happen. So this puts us now in line with, reflating, other assets. I think we're looking at the potential for a reflation in Indian equity prices as well. And specifically, there's the opportunity in the beaten down sectors, like I said, in stocks which have, fallen a lot and where there's value. Because if you just look at the main index, you can, end up thinking that it's too high still on value for the large caps. But we are also in an environment where interest rates have started to come down. So bond yields in India have actually fallen to 5.8%, which breaks a long-term trend line, which comes all the way back from 2002. Just to take that chart for a second and then come back to the Nifty. So this is a Indian 10-year bond yield chart all the way from 2001. And that time too, we'd cut interest rates down to around 5%. And that's when the Indian economy turned around and started to do well. And since then, rates have mostly gyrated in this range, which I think is a broad triangle that we've sort of maybe completed. And we are starting to break now. First, we broke the trend line from 2009. Now we are breaking the one from 2003. And my sense is that could mean, because these are a series of impulsive waves going down, is that we started wave C down, which means much lower interest rates, slowly being forced upon the market, because initially they had a lot of difficulty because of the NPAs to really transmit these lower rates. So they were cutting interest rates, but the banks were not really offering lower rates. Now, finally, with the open market operations, they've been able to push some extent lower rates through the banking system. And I think they're going to continue to try and do that, which is probably one of the triggers, I think, for the reflation of assets and pricing of assets in India. Because if you go into a lower interest rate regime, which we've probably not seen in a long, long time, then suddenly you'll have debt available at a much lower rate of interest than we've probably ever seen in the last 20, 30 years.
Could part of the reflation trade, Rohit, be agricultural commodities too? They're still in a long-term basing mode, and I was thinking that we were going to have some major lows in things like beans and corn and wheat into next spring. Is that on your radar agriculturally in India?
So there is a rotation in agro commodity prices. So each of them bottoming at a different point of time. In India too, we've seen some gyrations, but actually commodity prices don't fall too much. So the Indian agro price index actually holds up much better because the government somewhere provides a minimum support price for a lot of the
subsidies. Yeah. Okay.
So,
all right.
But they've also done something else. They've actually opened up the farm sector for distribution of farm goods just in the midst of this crisis. It was one of the biggest reforms which really nobody's talking about.
Interesting. Okay, we're talking about it. So it's not nobody anymore. Right? We talk about what no one talks about, Rohit. Okay.
So since you mentioned, and I do scan through all the global agro commodity price charts, and I do see rotation between them, not all of them bottoming at the same time. Right. But one which interests me and also is positive for India is actually sugar. So I'm looking at the sugar price chart. I could actually take a blank chart so it's much clearer. And what you actually see here at the fag end is one ending diagonal or triangular pattern. And at the same time, if I take a long-term trend line all the way coming back from 1984.
That was 2 cent sugar. I remember it.
Yes. So we're actually picking up, I think, close to the lower end of this channel. I would expect, but probably I think that sugar prices have already bottomed.
Wow.
And in India, sugar is a big sector to bet on. So a lot of sugar stocks are listed. They already picked up price action, and I'm already looking at them doing, gaining further on that side. So sugar is one sector which I'm closely watching for a turnaround. I think Similarly, we've seen rice prices also bump up a lot, but of course, there are no direct, you have to really find direct producers that can benefit from that in India.
Interesting. You know, it's great. I could ask you anything, and you've already been thinking about it. So, was there anything else you wanted to show us on any of the charts you brought? What is the analogy with the circles at the bottom on your volume chart?
Yeah,
High
so
volume being indicative of the washout and a major low. Is that what you're trying to show
climax,
us?
right? So we've had a selling climax very similar to what we saw. Probably 2008 was the last selling climax.
Yeah.
Now we've got one more, which is showing up here, and this volume pickup occurred with the broad market falling, of course, and now you had most of the large caps also correct quite a bit. So you had this major selling climax, including in the Indian banking sector. So the banking stocks had some of the highest volumes that they've seen in probably 2 decades in the last couple of months. And I think that selling climax is probably lead to the exhaustion at the lows and and the pickup. So which is why I've actually changed my count slightly, unless I'm proven wrong on the reflation theme, which is why I was earlier thinking that the fifth is over right here with this ending pattern ABCDE.
Right.
I am for the first time now, after this correction being done and stocks having crashed, taking an alternate stance that possibly this sell-off was a fourth wave, and we have a fifth wave, fifth of fifth, the last final move through
into what, about 2022?
Into 2022 or 2024, somewhere in
okay.
All right. Dollar cycle, then probably 2024.
Okay. All right. I know some other people that are looking at 22 or so for, the Fed bought us not 10 years this time, but maybe a couple.
Yes, it could happen much faster, as you're seeing, because if you reflate and you end up with high levels of inflation or unfortunately hyperinflation, then things can happen very, very fast.
Oh,
but let's see if that's the case.
Yeah. Wheelbarrows full of dollars, right? And people dump the dollars and steal the wheelbarrow, like the Reichsmark. You're not looking for hyperinflation?
No, I'm not. I wouldn't start by looking at hyperinflation because I've been given the argument by some people that you need to look at the speed of technological change as well, because that keeps bringing prices down while we try to keep thinking about monetary change only. So I'll avoid the hyperinflation argument, but what we can get is an attempt to reflate things, and that can probably push prices up faster than earlier. It may also have to do with a change in the volatility regime, which is we've been through a very low volatility regime for very long, where the VIX or even the India VIX remained at sub 10% or 12% for a long time.
Right.
We may have changed that, so we probably get more speed, which is good for traders and investors who like to look at charts. You don't get these boring long periods of consolidation.
Oh my God! Yesterday in the S&Ps, there were 3 or 4 vicious swings. It was like being on Space Mountain at Disneyland. So, you did it again, Rohit. Great presentation. So, besides at India Charts on Twitter, why don't you let our viewers know how they could follow you?
So I'll just leave with one last level, which is the parallel channel to the fourth wave, which stretches all the way to 19,000 on the Nifty. So that's the extreme upside. If we manage to get this thing to reflate, that's what we would end up probably seeing.
That's a doubling from where we are right now.
Yes.
Wow. Okay, so you can imagine the 10 baggers within a doubling of a range like that. So really great timing that you were here to give us your changing views.
The level that everybody's probably going to watch is going to be the 61% of this decline, which of course the US indices have already taken out. But the Indian index has not, for some domestic news flow reasons like the India-China thing we discussed earlier. And that level is 10,550. So I think that's the level at which people become more confident that the trend has actually changed. Till that point of time, most people are still questioning whether this recovery can go on. So that's all I think. I think most my updates, of course, India Charts is the only platform that I have that I continue to publish on a daily basis. I also write my monthly Outlook report, and all of that comes under one single subscription, which I've priced very, very affordably for most people. At,
Oh, you're
so,
not going to reflate your subscription price with the reflation trade?
well, in in USD INR terms, it might end up with a strengthening rupee. I might not have to do that.
All right, Rohit. I really appreciate you coming here and edifying the FACE community, my trading warrior brother. And it was great to have you. And I'll talk to you a little later on via Twitter, and we'll get back together in a few months or so and see how this wave 4 is playing out. Okay.
Okay, sure. Thank you.
All right, everyone. Rohit at India Charts on Twitter. Really insightful technician. And that's going to be a wrap for us, everyone. Good hunting. Remember, don't just count your pips, count your blessings, and we'll see you all tomorrow. Adios. Thanks again, Rohit.
Thank you.
You're welcome, Ingmar, Sanjay, Shepard. Adios.